Okay, so this last week is pretty simple. This is a brief review of what you have to do for the discussion, which is the importance of capital structure. What's the definition of capital structure? It's basically how much you fund your company using debt, which is where you borrow your money, and equity, which is shares that you sell, all right? So the key reasons is the cost of capital. You're balancing debt and equity, and that lowers the cost of capital, right? You don't want to carry on too much debt, but you have to carry some debt to build your company, obviously. And remember this, that debt always has a corporate tax shield, which is the benefit the government gives you for borrowing money. So debt is a positive in terms of funding, because you're always going to get that break, right? You're always going to get that tax break, okay? But if you put on too much debt, then that can cause, like anybody who takes on too much debt, business disruption costs, which means that now you got to worry about paying the debt. It becomes if opportunities come up, you may not want to take them because you don't have enough capital to take advantage of them. So it's not just as simple as taking advantage of the corporate tax shield, which is what we call it, but it's also an issue of that you don't want to take on too much debt. It gives you flexibility and it creates value, right? So in industry differences in capital valuations, in capital intensive industries that we have to manufacture, like automobiles or cars or things like that, you have high levels of debt due to stable cash flows and significant asset bases to use collateral. And valuations often rely on asset-heavy models. So you really have to, if you're building like a company, like think about Tesla, you got to really think about how much equity and debt you have to use, because you really need a lot of capital to run those companies. 10 companies have growth potential, but the problem there is you might not need as much capital space, because it's basically people that are creating these things. You need space, but you're not going to need it as if you're building cars or trucks or things like that. But you're also going to have that growth potential. So as opposed to a manufacturing company where the cash flows are steady, in a tech company the cash flows can vary a lot because you might have to develop product, you have to wait till people want to buy your product, like Google or something that works with Google or AI. So they have unpredictable cash flows, but they do have less of a worry in terms of how much space and how much physical capital you need. Service-based firms, again, you're providing services, so law firms, medical firms, things like that, insurance. They're basically giving you services. So in those cases, you still need space, you still need capital, but again, they're not so capital intensive. And financial companies, well, real estate companies, and even financial companies, I should say, like broker-dealers or Wall Street companies, you're going to use a lot of leverage because you're really being basically an intermediary. You're taking people's deposits and you're lending the money out. So you do that by leveraging the money, right? So, the government will allow you to leverage it, right? But so, for instance, if you get $1 million of deposits, you might be able to lend out, 8 or 9 million of that. And the $1 million is the amount of money you have to set aside, the required reserve ratio from the Federal Reserve. When deposits come in, you have to put so much money aside, and the rest could be lent out. Now, the government assumes that they watch what you do. The Fed has examiners, so you do use a lot of leverage, but the government is very strict in terms of what you can do and what you can't do. Otherwise, you have these banking crises. Now, how do you value these companies? So you look at the cash flows, basically, and you discount those cash flows. So if you have consistent cash flows like Coca-Cola or IBM, the values are higher because we know that those cash flows are consistent. And when we discount them by a discount rate, basically we know we can count on those cash flows to deliver earnings. So if we know we can count on those cash flows, it makes life a lot easier for us in terms of running the company and valuing the company. Because really, what's the problem with valuing a company? If I don't have a stability of cash flows, it's going to be a problem, right? It's going to be an issue. So that's going to be an issue, right? Regulatory constraints, right? Regulatory constraints. You also have to worry that the regulators don't come in, and they don't, they may, like if you have a utility or you have something like that, we have to meet regulatory requirements. And then you also have to look at your growth stages, right? What kind of growth are you moving in? Do you need a lot of capital now, or do you need less capital now and more capital later? So that's why, from a capital structure standpoint, a debt equity standpoint, you're going to look at these different points and see what the go look at these different points in time. You're going to see what the differences are in terms of building a company. So the different ratios are going to be of debt to equity, which is how much debt am I carrying versus total equity. That's going to be a key indicator for in most cases, and you want to talk about that a little bit. Generally speaking, you want to carry about 70% equity and 30% debt. That's the number I've seen over the years that really works for most companies. So if you have $1 million if you have $1 million on the asset side, right? If you have $1 million on the asset side, and you have, say, $3 million on the debt side, you're going to have $7 million in equity. So if you take $3 million over $7 million, you're going to get your debt to equity ratio, and that's going to be a number that's going to be bigger than 30%, but it's going to translate into like say 45% on that side. But think about it: if I have $1 million in assets and I want to carry like 30% in debt, then I take on about $3 million in debt. And then you got to watch how often you can cover that interest, because if I'm taking on debt, I got to pay for that debt every year. See, the good news is when I have shareholders, I could pay them dividends if I make money, but if I can't make money, or I'm not making enough money, or I need to put the money back in the business, there's no law that says I got to pay dividends. I only pay dividends when I have the extra capital, right? There's a lot of reasons why we pay dividends, but basically because I have extra capital, I want to give it back to my shareholders. Well, bottom line is I want to look at how much money I made, earnings, before I pay interest and taxes, and I want to divide that over interest expense. And if that number is steady, and that number can pay my interest expense, then I'm pretty comfortable. And finally, I'm going to look at my total debt over my assets to make sure that that's not too high. So a 2-to-1 debt to equity ratio may be acceptable in real estate, but anything below 1.5, if you're not covering your interest, then that's going to be a problem. So you want to talk about that a little bit on this discussion. If you're not covering your interest, that's definitely going to be an issue going down the road, right? And finally, you want to evaluate the financial health of companies. Make sure that they're stable. You know that companies that have steady cash flows, like utilities and manufacturing companies and IBM and Coca-Cola, those are going to be companies you can be pretty steady about, not worry about. But that's going to have to give you the optimal capital structure. So if you have a steady cash flow and it's really strong, you can take on more debt. That's what private equity does. It takes on more debt when it knows it's got steady cash flows. And you can see these are a couple of examples I gave you. You can use that. And finally, you want to evaluate the sustainability of each firm's leverage based on its cash flow predictability. So this is going to be a big issue. How predictable are those cash flows? If they're not predictable, that could be an issue. So this is all going to be in discussion. I want you to talk about, give me a couple of examples. Give me companies that you know that on the one hand are very steady with their cash flows, and on the other may not be as steady. And if you give me that, that would be a very good way to do this discussion. And this kind of wraps up this class. If you have any questions, you know where to reach me.